So in the last 5 months, I turned 20 grand into a $950 per month income stream using a very, very simple options trading strategy that takes me about 5 to 10 minutes each morning. Okay. Now I'm based in Australia. I'm on beautiful Gold Coast. I joined a program to learn this strategy, and I can link down below if you want the full details of it. But I want to give you the rundown of how this works and why I'm so excited. I'm not a trader in any way. I've got a stock portfolio, but I'm not a trader. I've never done anything with options. And so 5 months ago, I just started with a modest $20,000 balance just because I wanted to dip my toe in it and see how it went. And it has been such a cool experience to learn this game. The main reason that I got into it originally was because I wanted something that, as my sons, who are both really young right now, but as they get older, I wanted to be able to teach them a skill and a strategy that isn't tied to them starting a business in any one specific niche, isn't tied to them going to have to get a job. The world is rapidly changing, and who knows what it looks like by the time they are into their mid to late teen, they're going out into the world. I don't want to force them to do what I've always done. And so it was something that I really wanted to learn for them as well. So let me do my best to explain it simple. There are tons of different options trading strategies out there. What these guys do is 80% is built around one particular type of option that is called a cash secured put. When you sell a cash secured put on a stock, what is really happening? Okay, let's use an example. Let's say Apple is trading at $1,000 per share today. I can sell a cash secured put at, say, $950 per share, and I will immediately receive what is called a premium. Now, somebody else on the other side of this transaction is paying me for that option. They're paying me that premium. And what is fundamentally happening is that person is buying from me the right, but not the obligation to buy those shares at that price. On my side of the transaction, I'm ideally hoping that it stays above that price, that $950, which is called the strike price. And ultimately what then happens is if we get to the end of the week and it's still at $1,000, that option expires worthless, which means that I just keep the premium. Okay. That is the play 80% of the time. And so it's about picking positions, selling this contract, this put, this option to somebody who thinks that it's going to aggressively come down in that period of time, and they're paying me for that right. And so we're ideally collecting weekly cash flow by doing multiple of these at the same time. Okay. Now, obviously, with everything, there is risk. And so what happens in some cases is obviously the price of the share does go down, and then you have to make a decision. Now, the thing that I love about this process that these gents follow is that it's incredibly binary. It says if it's a Wednesday and the stock price is X% above, below your option, do this. It's incredibly clear and simple to follow. There is very little gut, which is what you want when it comes to these types of things. Okay. So let's say in that same scenario, Apple has gone from $1,000 down to $900, and we've sold this options contract at $950. We've collected some premiums, so we've got our cash flow, but now it's getting towards the end of the week and we're not in the best position. We're not in the position that we ultimately want to be, which is where these options contracts expire worthless. We have two options. We have two things that we can do. One, we can roll out that options contract. Okay. So we can basically kick the can down the road and say, I'm going to roll this out another week, another 2 weeks, another 4 weeks, and at the same price, and I'm going to see what happens. Okay. Now, when you do that, you will collect more premium because you're essentially buying back the original option and you're selling a new one. So you will collect more premium, more cash flow on your position, and you're getting yourself time to allow the market to recover, right? Now, in an ideal situation, let's say you roll it out 3 weeks, the stock goes back up to $1,000 and then expires worthless. Obviously, what can happen is that it can continue to go down. And so let's say that it goes from, we were talking about Apple at 1,000, we wrote our contract at 950, it drops to 900. Let's say we roll it out another 3 weeks and it's dropped to 850. It's going to ultimately hit a point where you can't roll that option out any further. Or you could roll it out, but there's probably not any financial return in order to do it because no one's prepared to pay you for that right, is essentially what's happening. And so in that case, we will be required to take assignment of the stock. So in our little scenario, we would be required to take assignment of the stock at $950. Come back to what I said originally, cash secured puts means that we're only selling these contracts where we have the full amount of cash in order to be able to pay for the stock in the event that we get assigned. You see, one area where people go really wrong with options is that they trade with leverage and they expose themselves such that if they get assigned, they can't buy the stock and then they blow up their account. But we're only doing cash secured puts. Okay, so that means that, all right, there's no more premium for us to roll it out, so I'm going to take assignment of the shares. The position that you now find yourself in is you get assigned the shares at $950 per share and they're trading at $850 per share. So on paper, you are down on that stock. Okay, now, first thing to understand is you're not just down the $100 per share. It's actually less than that because the whole time you've been selling the puts and rolling them out, you've been collecting premium. So your net cost on the stock is actually quite a bit lower. The other thing, and this is where it's really important that you only really do this with companies that you think long-term will be okay, you're comfortable owning shares in these businesses, you don't sell these puts on dog shit companies, is they're unrealized. That's an unrealized loss. You do not crystallize that loss unless you sell those shares today at their market price. So I get assigned these shares at $950 and today they're trading at $850. If I turn around and immediately sell them into the market at $850, I'm going to crystallize that $100 loss per share. But I won't do that. Why would I crystallize the loss? If long-term I think the stock is going to recover, long-term I'm happy to hold the shares. Maybe it's even a company that I would otherwise own shares in anyway. Why would I do that? Why would I lock in that loss? And the answer is you wouldn't. And so this is where the second part of the strategy comes into it with a covered call. Okay. And this is essentially the inverse of what we were doing before. It's just now that we own the shares. And so what we can do is we can turn around and we can sell an option into the market that says, I will sell you my shares for insert price. You collect the premium and then you see what happens over time. And it becomes a management scenario again of, okay, are my shares likely to get called away? Do I need to roll it out? Do I need to move the price on that contract a little bit? And that's where it does become a little bit more of a management exercise because you obviously want to make sure you aren't forced to sell your shares below the price that you got assigned them at, because then you will crystallize that loss. But as long as you can manage your way through those situations and you do this with companies that you fundamentally believe will recover and you're happy to own the shares anyway, then ideal scenario and the goal is that ultimately the stock recovers back to the price that you got assigned it at. So let's say we sell covered calls on our Apple shares at $875 and then it starts to go up. We can sell some at $900, $925. We get back up to $950. We've sold some covered calls and then we're happy to sell them back into the market because the goal isn't to own shares. The goal is to collect premium. We sell them back into the market or they get called away on that $950 call that we've sold. We end up net. We paid $950 for the shares. We get $950 back. And then our upside is all of the premium that we collected when we were selling the puts initially. And then we were selling the covered calls after we got assigned on the shares. Okay. And that's essentially the strategy in a nutshell, right? Now, there might be some language in there that, depending on your background, doesn't make a ton of sense. But once you dig into it, it's pretty simple. And so that's what I've been doing for the last 5 months, learning this from scratch and just with a small balance of 20 grand, giving it a go. And it's turned into a $950 on average per month income stream over that period of time. Just this month, I opened a second account inside a different entity in my business group, coming up on 3 weeks in. And it's that was a $14,000 balance and it's done $500 this month. And so just slowly increasing positions in this and looking to stack these cash flow sources. Obviously, one thing I talk a lot about on this channel is building a portfolio of income streams. And this is one that I've added in the last 5 months that I am very much enjoying. I'll put a link below to the full training that I'm following, and they give you the signals and all that kind of stuff if you want to check it out. But even if you don't go down that path, explore this as a income strategy. Don't go and put, look at the plane. Don't go and put all of your net worth into it, but as a skill to learn, I think it's really, really valuable. The main reason that I got into it originally was because I wanted something that, as my sons, who are both really young right now, but as they get older, I wanted to be able to teach them a skill and a strategy that isn't tied to them starting a business in any one specific niche, isn't tied to them going to have to get a job, because the world is rapidly changing, and who knows what it looks like by the time they are into their mid to late teens and they're going out into the world. I don't want to force them to do what I've always done. And so it was something that I really wanted to learn for them as well. So options trading, very, very interesting, can get incredibly complicated. You can absolutely lose your shirt if you go trade on shitty companies, use a ton of leverage. But if you keep it really, really simple, look into this strategy. It's also called the wheel in some circles. People use it. And then there's different variations of that as a strategy. But this is something I've been having a lot of fun with over the last 5 months, ramping it up a little bit more. Now putting a little bit, not going crazy, right? Like just slowly nudging it up, build it up to 2, 3, 4, 5 grand a month. I'll take that as something that takes me 5 to 10 minutes in the morning. That's a pretty healthy return on both money and time, which the time piece is critical to me, as you probably get that flavor through these videos on this channel. So wanted to flag that. That's something I've been having a lot of fun with the last 5 months, and might be something worth digging into for you. Appreciate you taking the time. Cheers.